at least 2030. So more and more estates being brought within the scope of UK inheritance tax. But of course, the big news is the restriction on the availability of business property relief and agricultural property relief. I'm sure everybody will have seen some of the reactions to that in the newspapers. Farmers are particularly cross about it. I gather there may be some demonstration in Westminster in a couple of weeks' time. But Lee, maybe I can ask you just to outline what the changes are and why everybody's so upset about them.
Yeah, thanks, Robin. And as you say, I mean, we have had a £325,000 allowance for inheritance tax for a number of years now, and that has gone against the whole estate. That allowance is set to be frozen. But we've also had a new allowance introduced. So essentially, where businesses and agricultural property have met qualifying conditions, it has been possible for the full value to be completely exempted from inheritance tax on a chargeable event, which includes death. The budget introduced a brand new allowance which effectively caps the availability of 100% relief to £1 million. Now, Amanda will talk us through how the allowance might work in practice. But essentially, the first million of qualifying business property / agricultural property will still benefit from 100% relief. But anything over and above that allowance will only get 50% relief, which results in an effective rate of inheritance tax on death of 20%. Now, within this new allowance, AIM shares, so shares listed on the alternative investment market, won't be able to be covered by that £1 million. So you have a situation where AIM shares that would otherwise have got full relief will now only get relief at 50%. Again, resulting in an effective rate of tax of 20% on the value of AIM shares at the chargeable event.
Yeah, so a significant restriction on the availability of relief and a potential 20% inheritance tax charge where there would otherwise have been no tax charge at all. Will people be able to pay that in installments?
I mean, they should be able to. I mean, you know, under the current rules where you've got shares in an unlisted family business, then there is scope to pay in installments. And normally without interest unless you default on the instalment payment. So yes, we are expecting installments to be available. But whether estates can raise the finance because they may be asset rich and cash poor, I guess is another matter for executors to have to consider.
Yes, absolutely. And if it's necessary to take money out of companies, for example, to pay inheritance tax, sometimes that can be done tax-free, but sometimes that may give rise to a distribution, or it may give rise to capital gains tax liabilities. But what about this £1 million exemption then, Amanda? How's that going to work?
Well, thank you, Leanne and Robin. I mean, the first things to mention are the allowance is going to be introduced from the 6th of April 2026. And there is going to be some consultation in early 2025. So that's something that it's just worth noting at the outset. And the way it's going to work is it's going to apply to the combined value of property in the estate that qualifies for 100% BPR APR. So by way of an example, if you've got £1 million of property qualifying for BPR alone, then that will fall into the entirety of the cap. Or, for example, if you've got a combined value of property worth £1 million, you'll get, for example, say 400,000 of APR and 600,000 of BPR relevant for the relief. If you've got a total value of qualifying property to which the 100% relief applies, if that's more than £1 million, then the allowance will be applied proportionately across the qualifying property. So, for example, if you had agricultural property worth 3 million and business property of 2 million, the allowance for the agricultural property and the business property would be, in that example, 600,000 and 400,000 respectively. It's, as Lee has said, assets automatically receiving 50% relief won't use up the allowance. And any unused allowance is not going to be transferable between spouses and civil partners. So that's just an interesting point to note. The way the allowance is going to work, it's going to cover the following transfers. So property in the estate at death, failed pets, and chargeable lifetime transfers where you've got an immediate charge. So, for example, where you get the property transferred into trust. Talking of trusts, the £1 million allowance is intended to be available for property that's in trust. As I'm sure most of our viewers will be aware, the trustees of certain trusts are liable to inheritance tax charges of up to 6% on the value of the property held in the trust on a 10-year basis, and when there is an exit from the trust. And to date, APR and BPI can apply to those charges. But again, there will be a combined £1 million allowance for the trustees on the value of the qualifying property, consistent with the new rules. Now, we have very little on that at the moment, and this is one area where the technical consultation in early 2025 rather, is going to be very important to have a look at. Just one sort of final point on trust. Where settlors have set up more than one trust, which comprise business property and or agricultural property before the date of the budget, so before the 30th of October 2024, each trust would have the £1 million allowance for 100% relief. But we're told the government intends to introduce rules to ensure that the allowance is divided between trusts, where a settlor sets up multiple trusts after the 30th of October 2024. So that's a timing issue, really. As Lee's mentioned, the other thing just to highlight is there's an exception for shares that are designated as not listed on markets of recognised stock exchanges, such as AIM shares, where the rate of relief will always be only 50% and won't be affected by the new allowance. Where we've got over £1 million worth of property, as I've said, the relief will be apportioned between the property. And so another example, if you've got, say, shares that are worth sort of 2 million in an unquoted company, if that would attract 100% relief on the first 1 million and 50% relief on the second million, we'd be looking at a potential inheritance tax liability of 200,000, which gives, in that example, an effective rate of 10% before you apply any other relief. Just two things just to mention as well. I mean, firstly, lifetime transfers prior to the 6th of April 2026. The rules apply for lifetime transfers on or after the 30th of October 2024, if the donor then dies on or after the 6th of April 2026. And this is effectively anti-forestalling. And those provisions we'll have to have a little look at in more detail. The final point is that estates will continue to benefit from the nil rate band, the residence nil rate band, and other exemptions as well. For example, the transfers between spouses and civil partners, and transfers to individuals more than 7 years before death continue to fall outside the scope of inheritance tax in the normal way. So pets continue to operate, and at least at present, that period of time remains 7 years, not extended to the perhaps expected 10 years in this particular budget.
And Amanda, oh, sorry.
Yeah, no, carry on.
I was just going to say, and it'll be all the more important for family businesses now to have accurate professional valuations to ensure that they know exactly how much of their allowance that they have.
even more importantly now, and I think 2 points that I think we always stress to clients are, I mean, evaluations, of course, can be complex and expensive, but they're one area of dispute between the revenue, which I think will be sort of brought into sharper focus in the change in the provisions. And generally having evidence in relation to the positions that you're taking with the revenue is very important going forward generally. So they're worth highlighting, I think, at the outset.
Good. So there speaks an accountant. Get evaluation. Very, very important. Now, just to clarify, or just to double check, that so where you've got spouses who have between them got business or agricultural property in excess of £1 million, then they're going to need to make sure that each of them has business or agricultural property in their estates to be able to make use of both allowances. As you said, Amanda, you can't transfer
Exactly.
unused allowance from one spouse to the other.
Exactly, Robin, that's entirely right. So I think for people with agriculture and business property relief issues, that there's going to be a necessity to look at the wills as well as looking at valuations and lifetime sort of transfers and planning as well.
Yes, and in terms of lifetime transfers, if people transfer agricultural or business property into a trust today that qualifies for 100% relief, that will still qualify for 100% relief today. So there won't be an entry charge on the transfer into the trust.
Indeed,
Right?
indeed, that which is why 2026 is quite an important date.
Yeah. Okay. Now, just sticking with inheritance tax, small change to the inheritance tax treatment of pension funds. Do you just want to say a few words about that, Amanda?
I'm just going to say very few words. I mean, again, this is from the 6th of April 2027. This change is coming in, but most unused pension funds and death benefits will be included within the value of a person's estate for inheritance tax purposes from that date, which obviously is a big change. It's a change for individuals. It's also a change for pension scheme administrators because they are going to become liable for reporting and paying any IHT due to HMRC. It applies equally to defined benefit and defined contribution schemes as well as non-UK schemes. And there are only intended to be very limited exemptions for dependent scheme pensions and charity lump sum death benefits. So it's worth just noting this change. The important thing I think at the moment to recognise is the imposition of inheritance tax will apply alongside the current taxing regime for pension death benefits, which means that effectively there could also be a charge to income tax in certain circumstances, and therefore will have an effective rate of 67%. So that is something really to be aware of in respect of pension funds. There are also changes to the qualifying registered overseas pension system, but that's really outside of today's talk.
Yeah, I don't think we got time for that. So thank you very much. So, I mean, inheritance tax overall, I think it's fair to say probably there were less changes than some people thought there might be. So no changes to the potentially exempt transfer regime, no changes to other reliefs, but the changes that have been made are significant and are going to have quite an impact on a number of people. So we need to move on, I'm afraid. So we're going to move on to capital gains tax. And the main change, of course, is to the rates of capital gains tax, which seems to me to be very confusing. So I think it would be helpful, Lee, if you could just run through what changes to the rates are being made.
Yep, no, sure. And I mean, you'll remember, Robin, in 2010 where we had a capital gains tax rate change mid-year. Well, we've got that again. And this was perhaps one of the most talked about changes in the lead up to the budget. As it happens, the rate didn't go up by as much as some people feared it might. There was speculation that the top rate of capital gains tax might be aligned with the top rate of income tax, which was the case before 2008, certainly. But what actually happened is there was a reasonably small increase. So the standard rate of capital gains tax of 10%, which broadly applied to basic rate taxpayers, increased by 8%. So that will now be 18% from 30th of October. The standard rate, or the higher rate, sorry, of CGT has risen from 20% to 24%, which aligns it with the rate of CGT on residential property, which was frozen at 24%. So actually that in itself builds a degree of simplicity into the rules, in that we don't have another rate to remember, albeit there are some changes to carried interest that we'll refer to briefly later. So that is quite simple and straightforward. The draft legislation suggests that where capital losses have been realised in the current tax year, that they will be able to be offset in the most beneficial way. So can be offset against gains taxable at the new rate, which will certainly be welcomed by those who've made capital disposals in the current year. And then there is mention of the temporary non-residence rules and how they might work. And just as a reminder, for individuals who are subject to the temporary non-residence rules, i.e. those who have broadly been outside the UK for no more than 5 calendar years, they are taxable in the year of return. And it looks like they'll actually be taxable at their previous rates, not the higher rates that were announced on budget day. So I'm sure that will be welcome too.
So that'll be on the basis that the gains were realised when the rates are lower, but different to the normal position, which is that the tax rates at the date you become resident again would apply.
Yeah.
Just worth mentioning, I guess, so gains on distributions from trusts, you can have this thing called the supplementary charge, which increases the rate of tax. At the moment, the highest rate, or previously the highest rate, was 20%, which would mean a top rate of 32% with the supplementary charge. That goes up to 38.4, I think, on the basis of a 24% rate of capital gains tax. So potentially a bigger impact on people who are taking distributions from trusts.
Yeah.
Okay, and then there were also some changes to rates and reliefs when we're looking at business asset disposal relief and investors relief. Amanda, do you just want to tell us what's happened there?
Yes, I'll just mention these relatively briefly as well, Robin. Obviously, we have 2 reliefs which currently offer a lower rate of CGT, as you've said, BADR, business asset disposal relief, and investors relief. And the rate for both of those reliefs is going to increase more gradually, as the government said, to give business owners time to adjust to the changes. So the BADR and IR rates will rise to 14% from the 6th of April 2025, and then will match the main lower rate of 18% from the 6th of April 2026. However, there was a significant restriction in respect of investors' relief. The lifetime limit has been reduced from 10 million to 1 million for investors' relief qualifying disposals made on or after the 30th of October 2024. And there are anti-forestalling provisions which apply where there's been a reorganisation of a company's shares before the 30th of October in anticipation of that particular reduction. So slightly good news on the rates, but rather bad news on the investors' relief lifetime limit being brought down to effectively the BADR rate level now.
Yes. No, I was reading in the newspaper this morning that some people think that these reliefs are poorly targeted. I think it said that Rishi Sunak took that view when he was Prime Minister, and that it's perhaps surprising in a way that they haven't just been abolished. Do you think the writing's on the wall?
It does seem like it is a gateway, isn't it? I think, Robin, to further discussion and consultation, and perhaps a removal of the reliefs ultimately altogether. It's unsurprising that investors' relief has been brought down, but I agree. I think there may well be further restrictions in the next budget.
So make the most of it. Right, Lee, you mentioned carried interest. So there's a bit of change where carried interest is concerned. Very, very close to some people's hearts. Yeah. What's happening on carried interest?
Well, there's been a rating. So carried interest, at least for now, remains within the capital gains tax regime. And as a reminder, for those who don't know, the capital gains tax rate on carried interest has been 28% for the last few years. That rate will increase to 32% from 2025-26. And then after that period, carried interest will fall within the income tax and national insurance regime. Now, there are certain intricacies with how carry will be taxed that are probably the subject of a separate webinar.
Yes.
But the headline for now is the rate of capital gains on carry has gone up to 32%.
I think that's right. That's definitely right, Lee. And they're intending at the moment, I think, for the deemed trading income, as you say, to come within income tax. At the moment, they're suggesting subject to a 72.5% multiplier to bring the rate down. But probably the only other thing to mention on carry is that income-based carried interest will now include employment-related securities as well. And that won't be qualifying carried interest for these purposes. So for any of our listeners who are listening in relation to carried interest, the consultation is going to be very important. They're consulting until the end of January next year, and we'll see what happens.
And I think, Amanda, under the capital gains tax revision, certainly, if you're non-resident and you don't fall foul of the temporary non-resident rules, it's possible not to pay capital gains tax on your carried interest. That's expected to change when it moves into the new regime.
Yeah, absolutely.
Yeah, so even people who are non-resident may be subject to tax in relation to some of the carried interest, depending on the extent to which they've been doing work in the UK.
Yeah,
exactly.
Which is a big change. And as you say, this is subject to consultation over the next year. We'll see where that ends up, but there is a potentially significant issue there for people who receive carried interest, but who have been doing work in the UK.
Exactly. Lots to talk about on another occasion.
Yes. Well, it links into our next subject, which is the changes for non-domiciliaries, because quite a number of private equity executives are in fact non-domiciled. So this is a bit of a double whammy for them, potentially. So we're lucky enough to have 100 pages of draft legislation and 34 pages of technical notes, which Lee and Amanda, of course, have scrutinized in detail and are now ready to tell you what the legislation says and what the technical guidance tells us. But the headline, of course, is that the concept of domicile is being removed from the tax legislation, outdated, we're told, and should be replaced with something more modern based on residence, which I don't think anybody would disagree with. There are obviously different views on the way that is going to be done, and that's what we're going to have a look at now. Firstly, in relation to income tax and capital gains tax, and then we'll move on to how things are going to work for inheritance tax purposes. So looking first at income tax and capital gains tax, the remittance basis currently exists for non-domiciliaries, so they can pay tax on overseas income and gains if they're remitted to the UK, but not pay tax on overseas income and gains if they're not remitted to the UK. That regime is being abolished and being replaced with what is being called the 4-year FIG regime, foreign income and gains. So we need to know how that's going to work and who's going to qualify for it. So Lee, I'm hoping you've worked that out.
Yep. And actually, the FIG regime was first mentioned in the spring budget by the previous government. and the principle of the FIG regime has been retained by the current government. So as we remove domicile from the UK tax code, and actually, just as an aside, we're not really removing it because we'll still need to understand how the rules work in prior years. But moving forwards, residence is going to be the determining factor. Now, for those individuals, and this can include Brits, so people who today we would consider to be UK domiciled, for any individual that's been non-resident in at least the last 10 years, those individuals, when they become resident in the UK, either for the first time or after a period of absence, will qualify for what we're calling the 4-year FIG regime. Now, FIG is an unfortunate term because it's used in other parts of the tax codes, but for these purposes, what we're talking about is foreign income and gains that arise within a 4-year window. Now, one of the key differences, apart from the fact that Brits can benefit from the FIG regime, is that whereas under the remittance basis regime, the money was taxable when brought to the UK, under the FIG regime, it's completely tax-free and can spend freely in the UK. Now, you need to claim it. It's not automatic. And you have to identify what you're making the claim in respect of. So there is some compliance here. And you identify your FIG on a source-by-source basis. Now, one consequence of claiming the FIG regime is that you lose your personal allowance and your annual exemption. But where the numbers are big enough, that's probably a small price to pay.
Yeah, Lee, just on this point, it seems quite important to me. At the moment, for non-domiciliaries who claim their remittance basis, they don't have to say anything on their tax returns about their overseas income and gains.
Yeah.
So what you're saying is that if you want to take advantage of the 4-year FIG regime, you're going to have to say precisely what income and gains you're making the election in respect of.
Absolutely. So accurate reporting will be absolutely essential for the claim to be valid.
Okay, and what sort of foreign income and gains are going to qualify for this exemption?
Well, we would imagine most sorts of foreign income and gains that would qualify under the current rules as relevant foreign income. There have been specific notes in the guidance around things like foreign partnership income, and what conditions would need to be met for that to be considered foreign income. And then the overseas workday relief that many of us will be familiar with, those rules have been modified so that rather than being subject to a 3-year limit, now are aligned with the 4-year FIG regime. There are some restrictions as to the amount of foreign earnings that can benefit from the new overseas workday relief. But by and large, there are lots of categories of foreign income and gains that can fall within this regime and be completely tax-free.
Yeah, so effectively it's foreign income and gains that would have benefited from the remittance basis under the existing remittance basis regime, and also income that would have benefited from overseas workday relief, although, as you say, subject to an important restriction, which I think is the lower of 30% of your overall remuneration, or £300,000.
Absolutely, yeah.
Which for some people will be a significant restriction.
Yeah.
So what about trusts, Amanda? Is it going to apply to income and gains of trusts?
It can indeed, Robin, and I think I'd start sort of this particular section by saying that I think 103 pages of draft statutory provisions is obviously complex, and its interrelation is still, I think, going to take some working out. Particular difficult areas are the timing on matching and the interrelation between the onward gift and close family members rules, and those latter two categories we're not really going to be going into much detail today. But specifically in respect of trusts, the FIG regime is going to include foreign deemed income under the transfer of assets abroad provisions and the settlement legislation, two of our most important anti-avoidance legislation provisions, gains that are attributed to participators in non-UK companies to the extent that they accrue from disposals of assets outside of the UK, gains attributed to settlors of non-resident trusts under Section 87 of the TCGA, again, to the extent that they accrue on disposals of assets outside of the UK, and all gains that are attributed to beneficiaries of non-resident settlements in respect of capital distributions under Section 86 or Schedule 4C. So all of our most likely candidates for FIG will be included in relation to this regime. Very broadly, the new provisions provide that where you have a UK resident individual who's eligible to claim the 4-year FIG regime and they get a distribution of foreign income from a settlement, then that will qualify. If they receive a discretionary income distribution, that's treated as untaxed income of the beneficiary, and that can qualify. And similarly, from a capital gains tax perspective, it'll also be possible to make a claim where the beneficiary has a life interest in the settlement. Interestingly, whether or not the settlement is UK resident, so even in relation to UK resident settlements, if they're chargeable on their share of the trust income as it arises, then you'll be able to make a claim for the 4-year FIG rule in respect of any foreign income in which they have an interest. Again, where you would be taxable as a transferor as a result of the transfer of assets abroad provision, this also won't result in a tax charge if you make a claim for the 4-year FIG rules or if you receive a benefit out of a trust which is matched. Interestingly, the amount of the benefit will not be treated as reducing the pool of available relevant income within the overseas entity for future matching purposes, and therefore, where you have a benefit that is effectively not matched to the foreign income of the entity overseas under the transfer of assets abroad, it may then still be subject to tax once your 4-year FIG period has ended and in future tax years. And a very similar set of provisions apply.
So, sorry to interrupt, Amanda, just on that.
Yes.
So if you receive a distribution, a capital distribution,
Yeah.
and it isn't matched against a pool of income in the trust because there isn't enough income,
Yeah.
then after the 4 years, if income arises then, you may be taxable.
Yeah,
on that
exactly.
benefit, even though you weren't taxable during the 4-year period.
Exactly. So there's quite a lot of intricacies, as I said, in relation to matching, in relation to these provisions. And there are similar provisions in relation, as I said, to Section 87 and Schedule 4C, which is where a beneficiary receives a benefit. And again, it will not be treated as reducing any pool of unmatched gains in those circumstances as well. So really, just to summarise the changes of distributions from an overseas settlement and the 4-year FIG, you have to have a beneficiary making a claim for the 4-year FIG regime, and then any income or gains arising within the overseas structure will continue to be added to the relevant pools. They will not be matched to any benefit that they might receive. So that's a beneficiary's position. Where you've got a settlor beneficiary of a settlement law interested trust and they make a claim, then they won't be taxed on the FIG arising in the settlement in the FIG 4-year regime as they arise. But you do need to report any benefits that you receive on your self-assessment tax return. And as Lee has said, very importantly, claim the 4-year FIG regime. Where you've got a non-settlor beneficiary, again, you can claim during your 4-year period. And if you in a later year receive a benefit outside of the period in which you can make your claim, you can still be taxed by reference to any FIG within the trust. So they're quite complex sort of factual scenarios in relation to what can be charged inside and outside the regime. So as Lee said, also, it applies on a source by source basis. So you can opt to include any benefits that you receive for an overseas settlement or structure from your claim. So you can sort of pick and choose. And if a claim isn't made in respect of the benefits for the 4-year FIG regime, then it might be possible to include the chargeable matched FIG within the TRF if you qualify for that as well. And we're going to come on to talk to the TRF about the TRF in a minute. But basically, the regime is in principle simple, but complex when one looks at the matching and the facts of each individual settler or beneficiary and the benefits that they're going to get from the non-resident settlement.
Yeah, I think this point that you have to claim the benefits is very important, because hidden away in the legislation is a provision saying that if you carelessly don't make the election, then find out 3 years later, you won't be able to make the election.
Exactly.
So the time limit for making the election is 31st of January, not the year after the end of the tax year, but the year
2
after
years.
that. So
Yeah.
you've got a certain amount of time to make the election, but if you fail to do so, and then there's an inquiry which makes it clear that you forgot to claim relief on some of the income and gains, then you won't be able to make the election at that stage.
Exactly. And the 2-year period is slightly longer, but if you miss your period of making your claim, then the results are going to be quite punitive.
Yes. Now, one point we haven't mentioned is treaty benefits. Has anybody thought about whether people who claim the 4-year FIG exemption will be able to claim treaty benefits in other jurisdictions on the basis that, or they may not be able to claim it on the basis that they're not subject to UK tax on worldwide income, only on their UK income and gains? I mean, I've heard differing views on this, and the way the exemption works is quite interesting. It's not an exemption from tax on overseas income and gains. It's effectively a deduction from your overall income for the purposes of calculating the liability. So it may be that people in the UK say that treaty benefits are still available, but I think that's going to be a question which other countries will want to be addressing.
Definitely, Robin. I think that's the way I've analysed it so far. But as I understand it, there are differing views, and I think other countries will not necessarily be so keen to accede to that position. So I think we'll have to wait and see.
Yeah. Well, so you mentioned the temporary repatriation facility, the TRF. So, of course, people who have been paying tax on the remittance basis may have unremitted income and gains. And the temporary repatriation facility is intended to encourage people to remit those income and gains to the UK at a lower rate of tax. Now, interestingly, if you read the figures from the OBR, they're estimating that these changes overall will result in tax of about £12.5 billion. But of that £12.5 billion, over £10 billion is raised from the temporary repatriation facility, which shows you how important that is in the government's thinking. So, Lee, what's on offer?
So unlike the FIG regime, which focuses essentially on new income and gains, the temporary repatriation facility is colloquially old income and gains. So for people who are UK resident and have claimed the remittance basis, as we said before, their non-UK income and gains remains not taxable unless it's remitted to the UK. Now, there may have been many reasons why that money wasn't brought to the UK. Might have been invested in other assets, for example, stocks and shares, paintings hanging on walls in overseas homes. Or it might be that it was very difficult to analyse the composition of monies in bank accounts due to the complexity of the mixed fund rules, and the potential for large amounts of that money to be taxed at the highest rate, particularly where it was really difficult to prove otherwise. Now, the temporary repatriation facility is intended to apply for 3 years, and I'll qualify what I mean by that in a second. But it's intended that people who might want to bring that money to the UK at some point in the future and have maybe not been able to or not been inclined to bring it to the UK before can now bring it to the UK at a reduced rate of tax without needing to analyse what that money actually represents. So how much of it might be income, how much of it might be capital gains. Now the rates are 12%. Well, they start at 12% for years 1 and 2, and it increases to 15% in year 3. Now, these years are actually the years in which you make the designation. So you designate what income or gains you want to benefit from the TRF. You don't have to bring it to the UK in the year you make the claim. So that's an important distinction. We've got the claim time limits for designation, but there is seemingly an unlimited period of time where you can actually bring the money to the UK.
So Lee, you could designate your painting in France, pay the
Yep.
tax, and then eventually when you sell it, you can bring the money to the UK at that point.
Absolutely. Having already paid the 12% tax if you make the claim in year 1.
Yeah.
I think it's important to say, though, that, you know, for individuals who've paid the remittance basis charge in relation to that money, and that £30,000 or £60,000, depending on their circumstances, that remittance basis charge cannot be used as a credit against the tax paid under the temporary repatriation facility. But payments of the remittance basis charge after April 2025, so for the tax year ended April 2025, can still be paid to HMRC in the current manner from an offshore bank account straight to the revenue, without that needing to be designated under the TRF.
Yeah, that's helpful. So, Amanda, do you just want to say a bit about how this works for trust distributions? Can you use a temporary repatriation facility for trust distributions?
You can indeed. Just before we get there, Robin, I'd just make a couple of comments following Lee's very helpful setting of the scene. I mean, firstly, I mean, obviously, if you have funds of uncertain origin or you haven't got records, it's going to be really important, obviously, to think about the temporary repatriation facility. I mean, the conduct recognises this could include clean capital amounts as well, if you haven't actually got the records to show that that is entirely clear. But of course, it's really important for individuals to keep their own records, because although they don't have to apply, give the detail when they're making an election under the TRF, they may well be needed for compliance checks further down the line. So I think it's just worth remembering that not having the records doesn't necessarily mean that you won't be engaging with HMRC in the future in relation to those sums. But yes, for individuals to whom the remittance basis applied for any year prior to the 6th of April 2025, the TRF will be available on offshore trusts as well. And those individuals can designate unremitted FIG they've received, benefited from, or that's been attributed to them from an overseas trust or other offshore entity before the 6th of April 2025. For these individuals, the scope of the TRF will also include pre-6th of April 2025 unattributed FIG that's held within offshore structures such as non-resident companies and trusts, to the extent that they're then matched with benefits that they receive during the 3-year TRF period. And the 3-year TRF period operates till the 31st of January 27, 28 and 2029 respectively. The TRF will not be available for income distributions from offshore trusts or other entities such as companies after the 5th of April 2025. And the reasoning for this is that it's only been expanded to bring in amounts of deemed income or attributed gains that arise by matching benefits or capital payments with pre-6th of April 2025 FIG. So that's the reason why that is the restriction. But from the 6th of April 2025, it'll be possible to treat a capital payment or benefit which is received by a qualifying individual from an overseas settlement or an underlying company as qualifying overseas capital. And then you can designate this benefit or payment under the TRF. It has to be matched with foreign income or trustee gains under Section 87, for example. When we're looking at, for example, sort of structures with multiple layers where you have, for example, UK source income that's paid up from UK res entities to a series of offshore companies or trusts in the structure, the person abroad for the purposes of the transfer of assets abroad provisions in the context of the TRF will be the ultimate holding company or the ultimate owner, such as offshore trustees. And this will mean effectively that income will be considered foreign source and available for matching benefits received by individuals for the purposes of designation under the TRF. So effectively, the FIG is then available for matching with those benefits or capital payments, as long as the transferor, settlor, or the beneficiary as appropriate hasn't already been subject to tax. So this is also available effectively, the designation process under the TRF in respect of trust gains. That there are some obviously interrelations then with the onward gift rules and the other anti-avoidance rules introduced in 2018, which we won't go into.
No, let's not.
but
the key is the income and gains have got to have been realised in the trust before 6th April 2025.
Absolutely.
So people might want to realise income and gains before then if they're thinking of taking advantage of the temporary repatriation facility.
Absolutely. That's necessary, and there is a period of time, although not a long one, in order to take advantage of this.
Yes. Okay. Good. We must move on. So quickly rebasing. One of the other transitional provisions which has been introduced is rebasing, but only to 6th April 2017, which is possibly not terribly helpful, and only for people who are currently on the remittance basis. So I don't think we need to say too much about that. People will take their own views as to whether it's sensible to rely on rebasing. I think one thing to stress is for people who aren't going to qualify for the 4-year FIG regime, so people who've been here for more than 4 years, they're going to move on to an arising basis of tax. So they will be taxable on worldwide income and gains, including, if they're settlors and beneficiaries of trusts, the income and gains of trusts that they have set up. So the temporary repatriation facility is something they will think about for past income and gains, but for future income and gains, that is something that they will be fully subject to tax on.
Exactly, Robin, and indeed that there has been a maybe slightly surprisingly sort of a retention in relation to, obviously the settlements legislation and the transfer of assets abroad provisions. We're basically going to a pre-2017 system again. It's worth noting that in relation to the transfer of assets abroad provision, there's going to be consultation, and we're expecting wholesale changes to the transfer of assets abroad provisions from 2026. And so we'll have to obviously see how those changes interrelate with that position.
Yes, I mean, one piece of good news, though, is part of this year's legislation is to introduce a right of reimbursement for transferors who are taxable on the income of overseas structures. So if you have a settlor who is taxable on the income of an overseas trust and company structure, then they will be able to require the trust or the company to reimburse them for the tax that they have to pay.
Which is really important and has existed obviously in relation to Section 86, but not in relation to transfer of assets abroad provisions.
Yeah. Good. All right. Well, in the last few minutes, we should move on to inheritance tax. So again, domicile is being removed as a connecting concept and being replaced with with something which they're calling a long-term resident. So Lee, who's a long-term resident for this purpose?
Well, a long-term resident for this purpose is somebody who has been a UK tax resident in at least 10 of the previous 20 tax years. So for those non-doms who were under the 15 out of 20 regime, this is obviously a shorter period, but crucially, this applies to Brits in the same way that the FIG regime applies to Brits, as it does to people who we would currently regard as non-domiciled and non-deemed domiciled. So it's actually a 20-year test, really. I mean, in the run-up to the budget, the commentary was always around a 10-year test followed by a 10-year tail, which very broadly means once you've been UK resident for at least 10 years, then you remain within the scope of inheritance tax, even if you leave the UK. And there was a lot of conversation around, well, how long is that tail? And is it appropriate that the tail should be as much as 10 years, particularly where people may not have lived in the UK that long in relative terms? Now, we've got some clarification on this. So the way this is intended to work is that for people who have been UK resident for the full 20 years, then they will be subject to a 10-year tail after they cease to be UK resident. And the significance of this is around the exposure to inheritance tax on their non-UK assets. UK assets will always be subject to inheritance tax under this regime. But there is a concession here. So those people who have been resident for fewer than 20 years won't be subject to such a long tail. So the minimum tail will be 3 years, and that's for individuals who've been resident for between 10 and 13 of the last 20 years. And then that will increase by 1 year for every additional year they've been UK resident, up to a maximum of 10.
Just as an example, if you've been here for 17 out of the last 20 years, your tail will be 7 years.
Correct.
Yeah,
that's right.
Okay.
That's right. There is a peculiar rule regarding children up to the age of 20.
Let's not go into that because we're short of time. So
I'm glad you said that.
Enough to say there's a separate rule for people who are under 20. So what about trusts? Well, actually, before we get on to trusts, Lee, what if people leave the UK before the 6th of April 2025 when these new rules come in?
Yeah, and there is going to be some transitional rules and some grandfathering. So for individuals who leave the UK before April 2025 and who aren't deemed domiciled, they're expected to be outside of these rules. If they are deemed domiciled but remain non-domiciled under general law, see, we still have to know about domicile, then they'll be subject to a 3-year tail under the guidance.
Right. So even if they've been here for 20 years, if they leave before next year, then they will only have a 3-year tail, which is what they would have at the moment under the existing rules.
Yeah, assuming they haven't acquired a domicile of choice.
Yeah. And somebody who isn't yet deemed domiciled, hasn't been here for 15 years, they will not become subject to worldwide inheritance tax at all if they leave before the end of this tax year.
Yeah.
Yeah. Okay. So just in the last couple of minutes, Amanda, how is that going to work for trusts?
Well, with trusts, Robin, at the moment, of course, non-UK assets that are comprised in a settlement are treated as what we call excluded property if the settlor wasn't domiciled at the time the assets became comprised in the settlement broadly, and that's obviously a fixed point of time. But from the 6th of April 2025, the excluded property status of non-UK settled assets will not be fixed at the time that the assets are added to the trust, but they will only be excluded property and not subject to IHT charges at times when the settlor is not long-term resident, as Lee has explained. So effectively, the assets can go in and out of charge. When a settlor is long-term resident, any assets that they've settled, even when they weren't long-term resident, will be subject to IHT, subject to provisions in relation to individuals, obviously, who have died. And there are complications in relation to whether, you know, a settlor of a trust has died before the 6th of April 2025 or after. But that's basically the headline in relation to trusts, that it's now going to be excluded property only where you're not long-term resident and not on the basis of your position when you settled the property. There's an additional qualification for qualifying interest in possession settlements, so that there's an additional test. Both the settlor and the beneficiary have to be not long-term residents. And effectively, for relevant property settlements, as I say, we've got a system where it's going in and out of charge depending on the long-term resident status of the settlor.
Yes, and if assets cease to be excluded property, cease to be within the scope of inheritance tax as a result of the settlor ceasing to be long-term resident, then there will be an exit charge at that stage.
Exactly. So for clients who are thinking of leaving the UK, particular attention will need to be paid to their offshore trust structures and the potential exit charge on becoming non-resident in the UK.
Yes, and one transitional provision for existing trusts is no charge on death if it's excluded property on budget day on the death of the settlor of the trust. Exactly.
And there are some other transitional provisions and some knock-on effects for the application of the gifts with reservation of benefit rules as well, which we'll all have to look at in some detail.
Excellent. Well, thank you very much. I think that's all we've got time for. So just remains for me to thank Amanda and Lee very much indeed for all of your words of wisdom. There's quite a lot for us to take away and get our heads around still, as you can see. There's various things we haven't covered. There is a link in the chat, I think, to Step's note on other budget announcements. So you can all have a look at that, but I suspect you've been bombarded with similar summaries from all sorts of people. So you may already have looked at something similar. Can I just invite people to participate in STEP's Global Insights Survey? So I think there's a slide on the screen now. There's a survey on attitudes to wealth and tax. We would like to have a response to that by the 13th of November, if possible. And if you're able to forward that on to other people who may be interested in participating in the survey, that would be very much appreciated. Finally, there is an online feedback form which will appear on your screen once the webinar finishes. If you're able to complete that, that would be very helpful because that helps with planning for future events. So if I can just thank everybody for attending and bearing with us, I hope you have found today's session to be of some benefit. Goodbye.